now is Rebecca Patterson, former Bridgewater Chief Investment Strategist. Rebecca, it's great to have you on. Let's start right there. How are you navigating this storm?
Well, I've had a preference for large caps for some time because I felt that small cap equities need more of a cyclical uplift that's sustained and ideally falling interest rates. So definitely stay there. These are going to be bigger, safer companies. I've had a preference for the United States. Obviously, so far this year, that hasn't been working. And I think my preference was largely because I felt the trade war would do even greater economic harm to some of these countries overseas that are being targeted. And I think really it's a matter of how much you're losing in those countries, unfortunately. I guess the main place that I've been pounding the table on is not in the equity market at all, but commodities, and particularly gold. I've been bullish on gold for about a year and a half, and I continue to be. And the main reason driving that view is central banks. We've seen central banks for the last 3 years buying over 1,000 tons a year, and that purchase continues. And it's mainly diversification that these central banks are doing to slowly reduce their reliance on U.S. dollar assets.
And we have gold trading at a record high, to your point. It also raises the question, I guess the inverse of that is, given the dramatic weakening we've seen recently in the U.S. dollar, do you think we are entering this period that everybody's warned about for years as a possibility of de-dollarization?
Well, I do think the gold reflects, again, very marginal incremental move in that direction. And I think that part of the weakness we've seen recently in the dollar, which is pretty extraordinary. Remember, normally when you're in a risk-off period, a trade war, you would have a stronger dollar. So the fact that it's weakened so much just this month against the euro, the yen, the Swiss franc, a number of other currencies suggests both fears of U.S. growth slowing that could lead to Fed rate cuts, making the dollar less attractive, but also, to your point, Morgan, repatriation of capital. Foreign investors who had put a lot of money into U.S. markets in recent years taking that home. I think it remains a question whether that's tactical, they're rebalancing and they want less reliance on the U.S., or if it could be a structural shift. And I think we need to entertain that as a possibility today, that this, not that it would continue at this pace, but that what we're seeing in the world order could change how different countries think about the U.S.
Given the fact that we have now entered what I will call a trade war with China, 145% tariffs on Chinese goods coming out of China, and they've got their own retaliatory measures on us as well. What does that mean for the relationship between the two countries, not just from a trading perspective, but also from a financial one, given the fact that we are intertwined to look no further, for example, than the Treasury market?
Yeah, well, I'm lucky as a senior fellow at the Council on Foreign Relations to have colleagues who do nothing but think about supply chains, global trade, and U.S.-China all day. And speaking with them earlier today, one thing that struck me about one of our China specialists is that China's President Xi Jinping has really been planning for this moment since he took power in 2013. They've been focusing on self-reliance. They also have a longer time frame than the United States does. He doesn't have to worry about midterm elections. So, from that perspective, I can see why they might not want to make a deal that quickly. At the same time, cyclically, obviously, China's economy is very soft. Youth unemployment rates are high, confidence is low, and they can't just keep doubling down on exports. At the same time, the U.S. also has its challenges, even though we've gone into this trade war with a very strong economy and the data still shows strength on a backward-looking basis. We do have an economy that's very sensitive to market conditions. So many U.S. households have their retirements, their savings, their money in the market. So these swings affect confidence very quickly. And we do have our electoral calendar. So it's interesting. I think both countries have things they could lose. Have reasons they don't want to capitulate too quickly. But I have to think similar to 2018 and 19, if the market pain becomes too big and the economic pain becomes too big for both countries, they'll figure out a way to come to a deal. I don't know when that's going to be, what it looks like, but I have to think that's going to be where we land. But I do think that this does some longer term structural damage to the relationship. We are moving in the direction of decoupling. So Americans need to find a new place to get their shoes, because right now 80% of them come from China.